Good morning. Welcome to Wise Insights. This is Yimin. Today is Friday, January the 16th. We're pre-market open. There's a lot to talk about this week. We have had key data points. We have the Clarity Act in crypto. We have the White House trying to put pressure on the Fed. And there's a lot of different rotational dynamics in the market. So let's begin. So the two big data points, labor market and inflation, the CPI, are now out for this month. What we see is that the labor market has held up pretty well. Net new jobs 50K, unemployment rate 4.4%. So this doesn't really concern the Fed just yet. Looking at the latest CPI data as well, core CPI actually came in lower than expected. Which actually give the market some confidence that we're not in a stagflation scenario. And of course, a benign set of inflation data will ease the fear of inflation resurgence down the line. And that should help the Fed also incrementally be more dovish over time as they achieve the target. So a healthy labor market with inflation moving down is exactly what the Fed wants to see. At the moment, the market projects 2 cuts for this year by the end of the year. So that hasn't really changed much, with the exception that the front 2 meetings, so the FMC later this month and the FMC in March, the market doesn't really expect anything to happen in those 2 meetings. And I think the Fed is quite eager to simply wait out and see more data points, especially given that we miss a lot of data points in Q4 due to the government shutdown. So they want to see that the decision they made at the end of last year are being validated by the new data points. And the market isn't really decisive on when the next rate cut is. So the most probable timing is June, but this could shift a lot depending on what we see in the next 5 months, of course. So a lot of uncertainty at the beginning of the year. We are not expecting a recession this year as well. So if the economy does deteriorate, if there is a sharp spike enough on payrolls, if earnings growth suddenly slows down by a significant amount, and then the market will definitely price in more cuts and potentially quantitative easing as well. And the big story in the recent week is that the White House or the DOJ is trying to bring criminal charges to the Fed, and that threatens the Fed independence. Trump is eager for Powell to resign so he can bring in a very dovish Fed chair and start cutting rates even more. And he has been pretty vocal about this plan. The thing is, Powell has only 4 months left on the job, and there is a degree of backfiring from Congress because the market really does not like the White House meddling with the Fed independence. And if the Congress starts to push back on the next nomination because of what the White House is trying to do to Powell, that could actually slow down Trump's plan in getting someone very dovish into the Federal Reserve. And historically, no president has ever been able to remove a Fed chair. So I do think, given the push and pull, this episode probably resolves by itself. And I don't think this serious criminal charges will be brought forward. Now, looking at the earnings season, so we're starting the Q4 earnings season this week. The big tech reports don't arrive until end of the month. So with Tesla first, and then beginning of next month. And for the SaaS companies, they're even further in the back, coming around beginning of March. The, the market logic is quite simple. So if we look at 2025, we had the S&P growing by about 16%. And that accounts for a roughly 12% to 13% year-on-year earnings growth, and then a slight multiples expansion. So the PE has gone up alongside EPS. And a lot of the earnings growth comes from margin expansion. So profit margins have gone up, even though the revenue growth was only in the high single digit. We managed to have a double-digit earnings growth. And if you look at the bottom chart here, so the top is the PE ratio. We are near the 10-year high. Although you could argue that since COVID, valuation has fundamentally shifted because of high fiscal spending and QE. So there has been an entire regime reset in the past 5 years compared to the 5 years prior to 2020. And if you look at PEG, so PE adjusted growth rate, we are actually trading near the median. The market is okay with high valuation as long as growth rate supports it. And for 2026, what we could expect is that revenue growth coming again at 7 to 8%, but earnings growth coming above 2025, more towards the 14 to 15% mark. And if you hold, the stock market can grow by 13 to 15%. And that actually has been the historical average for the past 10 years. Looking from a technical point of view, using Elliott wave theory, what I see is that since April, we've had a reset. So we've got a wave 1 and 2 in the immediate aftermath of the tariff meltdown. And then the wave 3 has been an incredibly smooth ride up, where a lot of people were left behind because they were still skeptical of the rally, probably all the way until late August. And then into November, we had a bit of a liquidity wobble because of the government shutdown. A lot of cash is being hoarded by the Treasury General Account. And so there was a liquidity issue, which I can show you in a separate chart. So we've had a mini correction, but at this time, I didn't think this was going to be a full-on, a bigger correction because volatility was actually still very benign compared to the March-April period. And since the new year, we've had new all-time highs, and we're clearly in this new set of impulsive move up in this large degree wave 5. SPY has managed to escape this dense volume profile region, and that means the path upwards could face very little resistance. And in the past couple of days, we're actually seeing SPY hovering around the all-time high and not letting down even when the mega cap individual stocks have fallen. So overall, I do think there is a lot of risk appetite back on the table. The high yield credit market is also booming recently. There's a lot of demand for risk assets, and you can see down the line, cryptocurrencies have also seen a bounce. So I do think in the near term, in the next 1 month, going to probably mid-February, we are still going to go higher in the SP 500. Going into the second half of February into March, the seasonality factor is a bit unfavorable for S&P. So I would expect some pullback or certainly some headwind going to the second half of Q1. Looking at QQQ, so QQQ is more tech heavy, and tech hasn't done extremely well in the past couple of weeks. So QQQ has stalled a little bit. It hasn't made a new all-time high like SPY did, But overall, we are above the 50-day moving average still, so that has provided solid support. We are trading just around this trend line resistance with a large volume profile building here. I do think we will resolve higher in the short term towards the 650 region, which will be a new all-time high for QQQ2. But I think in the short term, there's a lot of rotation at play, and we need to be a bit more patient. Who's benefited from QQQ stalling? The Russell 2000, the smaller cap companies. They are more high beta, and since the new year, they've just gone straight up. And that is a big contrast compared to the bars seen in November, in which a lot of high beta names lost 40, 50, 60% from the low all-time highs. So I don't expect IWM to go to 290 in a direct straight line. So we will get some retrace, but overall, I do think 290 is very achievable this year, and potentially even above 300 to complete all those 5 waves. Looking at the 30-year yield. So the 30-year yield doesn't trade in line with the front end because the curve started steepening quite a bit since November last year. A lot of that to do with forward inflation expectation, but also the supply risk of a large budget deficit. So there is a concern for the US government being very ill-disciplined in its spending and therefore issuing a lot of notes and loan and bonds. That basically raised the term premium, investors demanding for higher yields for holding on to treasuries for a long time. However, we could have topped out around 4.9, which had been our target for this wave C. So this region has played out perfectly for us. It's now below the 200-day moving average. So potentially we could be having a reverse leg down next for this larger degree wave 3. And wave 3 could go all the way down to 4.1, which does sound quite ambitious now. So it could take a while to get there. TLT. So TLT is almost a mirror image of the chart I just shown for the yields. And we could have bottomed here around 86. If that is the case, we're quite early in this next bounce. We have just made above the 50-day moving average, so that's constructive. And we are now getting past this potential resistance as well. For the larger degree wave 3, I could really expect TLT to move past 100 or even 102 before a retrace in wave 4. Again, this will take some time to play out this year, but from the larger degree view, this does look quite favorable for moving higher. US oil, because of the geopolitics, the situation in Iran as well as Venezuela has made the near-term supply shock a bit more uneasy, which is why we saw oil spiking for a couple of days. But fortunately, there has been de-escalation between the two sides. Trump commented that Iran has stopped killing, so the US wouldn't intervene. And now we're seeing US oil moving back to inside this downward channel. So more or less, this downward trend is still intact. I'm not as comfortable as before because of this spike. This could still be an expanded wave 4 flat on the downside, and we can still get a wave 5 next. But now the risk of further upside has risen because of the geopolitical situation. So for now, the primary expectation is still this downward trend towards 60s, but don't rule out the possibility of this being a 1-2 setup for the high side. And I think the price would ultimately tell us which way it leans. For Bitcoin, we are seeing a breakout after a draft of the Clarity Act has been shared. So the Congress is doing a markup this week, but it didn't get passed because of a sticking point between the banking sector and the crypto sector about stablecoin yields. So the banks are arguing that stablecoin yields really are like interest on deposits, and therefore the crypto industry should be more regulated like a bank would be. And they're really concerned that if stablecoins start paying yields, then consumers will not deposit money into banks, which will reduce their liquidity, and instead put money into stable coins, which will be a win for the crypto industry. So I think the original draft was against stablecoin yields, but because of the debate on both sides, it's now been delayed. And we saw a retrace in crypto as well as the exchanges like Coinbase and Robinhood last night. The thing is, I actually don't think the delay in the Clarity Act is necessarily bad, because ultimately, once this bill is passed, it's very difficult to change. So now is the opportunity to get the most favorable terms for the crypto industry. And the fact that they didn't pass the bill is probably actually favorable for crypto in the long run. So I'm not too concerned about the overnight job. I do think, looking at the charts technically, we largely have bottomed here, and with the November low being the true low, and this being a 1-2 setup, and we could be moving in wave 3 for Bitcoin towards 105K. And even if you look at the overnight job, that was still above the January 5th high as well as the December high. So this price reaction is still pretty bullish. And just looking at what we had back in March, April last year, the two charts look very similar. We broke above the resistance trend line, and we started a new rally. So I do think the 4-year cycle could be proven wrong quite quickly. And of course, we need the price action to cooperate in that case. So to summarize, 105K is my near-term target for this wave 3, and ideally above this 200-day moving average. But that could be the first resistance alongside this volume profile for this wave 4 retrace. ETH hasn't quite broken above the December high, so structurally is slightly behind the Bitcoin, but that has been expected. Bitcoin tends to move first in the rallies. And why I think this is 1, 2, 3, 4, 5 for this initial wave 1, just under the 200-day moving average, get a sub wave 2 retrace before attempting the highs of 4,500 to 4,600 again. So I do think there needs to be a bit more patience, but we are seeing higher lows over here, as well as positive momentum, positive RSI moving higher, and not quite into the overbought region just yet. So my near-term expectation is for it to complete this initial wave 1 around 3,500. Solana, also very similar, broke above the resistance, as well as the 50-day moving average, is now sitting at the top of this volume profile. So I really want to see a challenge in the 200-day moving average around the 171 before the next pullback. XRP has pretty good relative strength, even though in the past couple of weeks it's pulled back slightly. Still above the 50-day moving average, so that's still constructive. And I think on the larger degree chart, this is a running flat. So we've got a wave A here in April, and this was wave B rally in 3 waves for the July high. And then we finished with wave C low in December. So the next move up is wave 5. So we're at the very beginning of this phase, and wave 5 could really attempt the $5 handle. So that sounds ambitious from where we are now. So it's more than double, but given the wide trading range in this consolidation zone, once we break out, I think 5 is pretty reachable. Looking at Coinbase, admittedly, it's been a much harder name to dissect because it's not quite as pure as cryptocurrencies. It also acts a bit like an equity name. So in terms of the projections modeling, it's much harder to predict than the cryptocurrencies themselves. So we've had an ABC correction in which there were 5 waves for this wave C downside. And I do think December completed this wave C. There starts to be a lot of accumulation around this region, which is good for the next rally, but we're still below the 50-day moving average, and we haven't really shown that much relative strength compared to other names. So I'm still cautious about the bottoming process here. So we made a new low in December, so that always takes a bit more time to digest compared to if this November low was held. Overall, I do think this is a wave 3 and wave 4 retrace, and we do get a wave 5 here. There is a big correlation between Coinbase and Bitcoin and ETH. So if we get a big run in crypto this year, which I still expect to be the case, I would not actually be surprised if that Coinbase will take out this high and went on even maybe another 50 to 100% higher for this wave 5. Looking at Robinhood, unfortunately, the retrace yesterday now makes the bullish structure or this 1-2 setup a little bit more vulnerable. So this wave 2 retrace reached the 78.6% retrace of this wave 1, which is a classic wave 2 target zone. But it's so far holding this region, so I'm not quite as concerned. If we make a new low, I'll be a lot more concerned, but it is a volatile stock. So in this recovery process, there will be a lot of quite sizable moves ups and moves downs. So for now, I'm still keeping this bullish structure with wave 3 target around 170 plus. And the headwind right now is that Robinhood did incredibly well in Q3, but since Q4, when we had a crypto crash, the trading volumes have declined quite significantly, and they report every month. So the key story for 2026, I suspect, will be the crypto recovery. So when the crypto market recovers again, we are going to see could see a pretty recovery in the charts as well. And secondly, Robinhood is moving into prediction market in direct competition with Polymarket and Kalshi. So that could be another very fast revenue growing line, and it would be independent of the crypto recovery too. MSTR strategy, we saw a low on December the 31st, a little bit like Coinbase. And since then, we've caught some risk on bids going into the 50-day moving average. It's been rejected at the 50-day moving average. So now it's turning down again. But I do think overall this should be the bottoming region between the 150 and 190. And as it consolidates, my expectation will turn more bullish. And I do think it will rise with the crypto recovery. And what you can see is a bullish divergence, so higher RSI lows versus lower lows in price. So you're seeing slightly more positive momentum even as the price declined. So that is another sign of a bottoming signal. Bitmine, Mr. Beast recently. Uh, so it really likes to take a lot of the moonshots that potentially could play out well, but if not, we still have the ETH holding that will raise the boats when the tide comes. So at the moment, we are still behind the 200-day moving average, but also this VWAP from October. So what would really send a bullish signal is to directly climb above this VWAP at 38. That would give us the confidence is moving towards this wave 3 target at 71 alongside the ETH recovery as well. So Bitmine is a 10 billion market cap stock. It trades with a premium to its underlying holdings, and that MNAV could easily expand when ETH starts recovering. It's still very early days in this recovery phase. We just have to be a bit more patient. SharpLink, I really like SharpLink's focus on ETH in terms of the strategy for staking and participating in liquidity pools and trying to get more yields for the shareholders. They're a much smaller market cap compared to Bitmine, but it's run by two industry veterans. One is a co-founder of Ethereum, and the other one is a former executive in the crypto ETFs for BlackRock. So these guys know exactly what they're doing and the strategy going forward. So I really like SharpLink in terms of its focus. It trades at a 15 to 20% discount in terms of MNAV. So you're getting actually your ETH holdings at a cheaper price than directly buying it. At the moment, it's just managed to get past the 50-day moving average. I suspect the real resistance will come around 15, where there's the 200-day moving average, but also the heavy volume profile from those who want to finally sell at break even because they bought over here. So overall, I'm cautiously optimistic, and I do think the crypto recovery is in play now. Gold, the gold chart, almost the polar opposite of the crypto chart. Since November last year, it has had a hot run recovering the previous high, and now we are trading a new all-time highs again. We are approaching our initial target for this wave 5, which is 428. So we're pretty much there. It could still stretch higher, and I think it could stretch higher with improving liquidity and the equity market moving higher too. And potentially when the equity market starts rolling over in February due to seasonal correction, gold could have one more safe haven trade in it to get a high around 440 or even higher. But looking at the RSI chart, this is the bearish divergence. So this is the opposite of MSTR. We're seeing higher highs in the price, but lower lows in RSI. So this is a topping signal that you need to watch carefully. So personally, I wouldn't chase it here, but I wouldn't short the market either just yet, given how strong the trend is. GDX, so gold miners did reach our initial target for this wave 5. It can definitely stretch high above 100, but the majority of the gain to me on a technical level is behind us. So I would be quite cautious and not to chase the name. Silver, we've had one parabolic run into October and then another parabolic run towards 80 today. At some point, it is due a retrace. As you can see, the RSI start diverging as well. So higher highs in the price comes with lower highs in the RSI. So that, again, is a topping signal. It's tricky to short this name because parabolic runs could really squeeze out everyone. And you're seeing huge volume building here. So there's a lot of interest now because the price has risen a lot. So a lot of participants are chasing the gains in silver. Personally, I would be a bit more neutral here, strictly follow our machine learning signals on the signs of top. Silver miners, we're seeing all 5 waves potentially completing in this wave 3. And we could get a one more push higher towards above 100 to complete this wave 5, completely feasible. But I do think the biggest gains now behind us. I would trade quite carefully around here. PALL, so palladium, it hasn't made a new high since this drop. So we could still be in this wave 4 drop with the target below the 50-day moving average. We just need to be a bit more careful here. And I do think it depends on if the rest of the commodity markets start moving down together too, then we could get this correction earlier. Platinum, we have potentially completed the 5 waves here. Again, we want to look at the palladium platinum ratio to see where the two are trading, which is here. So platinum has had a significant rise against palladium from almost parity in October to 1.3. So this is typically when you see people start selling platinum and buying palladiums for this ratio to go down. So we saw this back in June and October. Just a bit more wary that platinum could be sold into strength here. Copper, potentially copper could rise a bit further into this wave 3 target at 39 before retracing wave 4. So that would be also near the top of this price trend channel here that has been a source of resistance for the past couple of years. Uranium, we've been pretty lucky in catching this rise at the beginning of the year. So year to date is already up almost 20%, or actually 21%. And this to me looks like a wave 4 decline over here. And we are now looking at wave 5 target around 66. BCI is now in the highs of June 2022. And what this does look like is potential a cup formation with a wave 4 being the handle of the cup and handle before the next wave high in wave 5. So if that is the case, we can see BCI retrace below 19 for a shallow wave 4 pullback. And of course, this could stretch high and go all the way to the very top of this June 22. But for now, I much prefer to for the pullback for the re-entry than chasing this trade. Apple, once it fell below the neckline, managed to find a support region here around 255, and potentially we could have topped in this wave 1, unfortunately ahead of the earnings. But we can get a wave B bounce in after the earnings still, so that could re-challenge this neckline here, but I could see it's around the 50-day moving average 270 with this heavy volume profile. So overall, I'm leaning a bit more bearish on Apple after this relentless run into December. And I'm a bit more cautious that the next bounce is a corrective rally instead. Amazon, I have been bullish for Amazon I do think this is an accumulation pattern. It managed to escape from it, and that should help us get into higher highs this year. But to play devil's advocate, technically, this rally here is only less than the 120% extension of this wave here. So there is a possibility this is a wave ABC rally, and that is an overall large degree with B bounce. And with B bounce means that we should see a lower low in wave C for this wider flat in wave 4. So to invalidate this bearish alternative, we need to just keep on pushing towards this wave 3 target above 254. So for now, it does look a little bit more neutral than before because of this little sell-off we've had, but I'm keeping my primary thesis towards a more bullish potential for this wave 3, towards 254 or even 270 before wave 4 and 5 higher. Google, we've had a very shallow retracing this wave 4, so I'm waving the flag on the bearish thesis of this being a potential wave A, B, C. We've gone too far above this high now to have this as a valid wave B. So now the path of least resistance is just keep climbing towards 350 or even 360 for a stretch. It's just been on a very smooth ride since the April low. But the move does look quite stretched here. Historically, we've had retraces after we reached this type of rally from the lows, and the valuation has moved from the 5-year low, 5-year high. So I am getting cautious on the name, but I definitely wouldn't chase. And just want to see how it fills out this wave 5 for the next move. So Meta, we've had a retrace as expected. Previously, I said that we potentially could still have this wave 5 new low, but even if this is the low, we still would have a 1-2 setup, so a retrace towards 600. So we're getting there recently, and for those who are optimistic, I don't mind an entry near where we are now, around 600 to 617. And that could be playing for 1-2 setup for the wave 3 next. But I definitely would have a stop below 580 as a strict risk management tool because of how bearish this decline has been below, and it's now below the 50-day, 200-day, and this volume profile here. So there's a lot of pressure on the stock. So going long requires a lot of strict risk management. Microsoft, unfortunately, will breach this consolidation price channel now below the 20-day moving average. There's not a lot of volume profile here for support. We can easily get a new low towards 450 and below, so even 440 here. It's quite disappointing because my previous hypothesis is that it's wave 3 and wave 4, and we're getting wave 5 higher, but now that's being invalidated. I probably wouldn't touch Microsoft until I really see a sign of consolidation here. NVDA, so the chart is actually not that clear because it's just been hugging the 50-day moving average, but above this volume profile. So overall, there's still a very good chance we're moving in wave 5. Interesting fact is that for the earnings in tech companies for the projected earnings for Q4, the tech sector in S&P is expected to grow by 25% year on year. But if you strip out the NVIDIA element, that growth rate becomes only 18%. So that tells you how important NVIDIA and NVIDIA's results is the health of the index. So NVIDIA definitely has a lot of power. People would not want to see NVIDIA rolling over in a meaningful way. However, there's a risk. This is ABC, and we've only got ABC bounce. So I really want to see this being invalidated, which will give us a more bullish path towards our ultimate wave 5 target. Tesla is quite tricky. The valuation band is now at a historical high, even though it has been trading at very high valuations all the time. So here, for this ultimate wave 5 target, which I think is still in play, I much prefer a stop, very shallow stop thread zone, so just below the highs of this November region here. Because going below this, really, there's not a lot of volume for support, and the next feasible target is the November 14th low around 380. That's pretty wide in terms of risk reward for playing this wave 5 setup, so it's basically not worth it. So here I would get a 5%, or look at a 5% stop here, and trying for this 20% upside. But the tricky thing is, because Tesla can be quite volatile, you could really knock out this stop loss in one day. So maybe a better stop is just put it slightly wider to the 2 standard deviation of the intraday moves of Tesla, which is about 8 to 9%. That still gives you a okay-ish risk reward compared for this wave 5 low. That's ultimately up to you on how you want to manage the risk. I'm just giving you some different ways to think about it. PLTR, not a lot has happened since last week. We're just moving sideways here. And still this head and shoulders pattern is in play, but we're above the neckline. So for now, we're safe. There should be a lot of support around 160. Just really need to see how the price resolves itself in the near term to pick a direction. To invalidate this pattern, of course, we need to take out this autumn high in November. So the stock really just has to prove itself whether it has top or not. AAPL, it has been a little bit volatile in the past couple of days. And what I can see is that we could be retracing a little bit further to 530. This would be 530 to 570, could be the standard wave 2 target. And we can get a smaller degree 1-2 setup for this larger degree wave 5 here. And potentially we can get even much lower, higher in this next target. In short, it could still move lower, but I think the bullish trend is still intact. I wouldn't lean too bearish just yet. ORCL, so we had a December low here. That's potentially the bottom of wave 5. It's slightly short of the target, but now we're seeing a big accumulation pattern here in terms of volume. So I think there is buying interest in this region, potentially for the bottoming phase. But given the shape of this decline, we could really see potentially just an ABC correction going into 270, where there is this volume profile here acting as resistance. So for now, we just have to watch how it reacts. I don't really like to trade this pattern here. It's quite variable, less predictable in terms of timing and strength. So it's definitely one for watching rather than trading right now. CrowdStrike, potentially this is a wave 1-2 setup. Inside a wave 1-2, inside another wave 1-2 from the April low. I like the stock fundamentally. The valuation is always quite expensive. It's come off from the highs quite a bit since November. The 200-day moving average has managed to hold it in the past 3-4 occasions. And there's strong volume support around 425 region. So for the long trade here, I would have a stop below this wave 2 low here, around 400. That gives us enough distance so we don't get knocked out of the trade easily, but also justifiable risk reward towards this 730 target. Cloudflare is hanging on to this supporting region here, and you can probably make out a head and shoulder pattern And this volume profile to act as a potential resistance. So this could be a potential ABC wave lower that could trade towards 150 or below. So I'm a bit more cautious on Cloudflare, but I do think overall this could be an attractive entry for the next wave higher once we get there. SOXX semiconductor has just been moving higher with strength alongside the S&P. We are now well inside our wave target, which is 330 to 350. It could stretch towards the upper end of this because of how strong it is. And if you are really bullish to say, okay, this trades like S&P, and we can get up to 5 wave higher, we could even make a case for a smaller degree 1, 2, 3, 4, 5 here. So this is actually not even the top. We could get a retrace once we get to the 370 level, and then even one more high. But for now, it's a bit early days to predict this. So we are keeping this potential bullish option on the table, but it's not quite the primary expectation just yet. Broadcom, I think Broadcom has been weak technically because we couldn't quite get a bounce above this January 2nd high. But there should be one more high in the near term to complete this wave B. And of course, there is a case where this gap doesn't get filled until later, and we are actually bottomed already for this wave 4. So we're directly moving higher in the next bracket, wave 5. I'd just like to be a bit more cautious on that read. This could be an ABC wave bounce, and with one more low towards the 200-day moving average. I think the stock has to really surpass this high at 410 to invalidate this read, and then we can start thinking about the next wave 5. ASML, again, now on the upper end of our wave 5 target. So the 200% extension of this wave 4. I would say that I'm probably not chasing the trade here, and I'm quite cautious going in here in this topping formation. So this is a parabolic run straight up from 1,000 to 1,300 in a very short period of time. So I'll probably sit out of this trade over here. I'm holding. We're now inside this wave 2 correction zone, which is the 0.618 retrace to the 0.78 retrace. So there's no sign of bottoming here definitively. So it's worthwhile just waiting to see how things move from here. But there's initial bullish divergence where the lower low shows up with a higher low in the RSI. So this is the one where I think patience is needed for the bottoming formation before trying our luck for the wave 3. Finally, AMD. I was leaning a bit skeptical that we could get a gap fill first for this wave 2, but the stock managed to escape from it. So it's made a new high, and we could be on this wave 3, but the strength of this high isn't quite enough to give us the confidence that this rally is impulsive yet. So we just have to see from here. So that's it for this week. Thank you for joining me. We'll